Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. Today we're analyzing current market conditions. As stocks look to solidify a new rally, what could boost the uptrend or unravel it? Financial advisor is here to give us his take on the recent volatility and two big cap tech stocks. And for this week's technical analysis, we're putting Microsoft and Apple head to head for a key lesson about timing when it comes to buying tech heavyweights. Plus, we're speaking with the strategist of QQQ to learn how the tech heavy ETF could help you capture gains not only from top technology stocks, but other innovative sectors too. Investing Strategies starts now. Okay, let's begin with this week's market insights. Joining me for today's discussion is John Burke. He's the president of Burke Financial Strategies. Thanks so much for coming on, John.
Hi, good morning, Alyssa.
All right, so it looks like we're starting off the week with a little bit of upward momentum, but what do you make of all of the volatility we've seen as of late? It looks like we're still not quite out of the woods yet.
Alyssa, last week was what we call a three-alarm week. It was the worst week we've had all year. And usually the market doesn't bounce right back from such a dramatic week, stressful week. The first alarm was, of course, the inversion of the yield curve. We'd already had an inversion of the very short Treasury to the 10-year Treasury, but last week we had an inversion of the 2-year to the 10 and to the 30-year, and that is a major bear market signal for a lot of investors. Second alarm was Trump escalating the trade war with China, and then the third alarm would be the unrest in Hong Kong. All of these things are enough to really unsettle the markets, and we doubt that it's just going to bounce right back from that. We probably have a few more days, if not a few more weeks of stress before the markets march on up.
Yeah, I mean, between the headline risk that's ongoing, and then from a technical perspective, we're still not seeing the major indexes above their 50-day moving averages. IBD would like to see that in order to really feel like we are going to continue this upward momentum here. But speaking of the yield curve, what do you make of the bond market right now? It's not really as an appealing place to be right now for your clients, is it?
Well, first of all, bond yields have gone down. The 10-year was at 3.5. Now it's up to 1.6 today, but it was below 1.5 last week. So it's come down a lot, and that worries us a lot because in the long run, that means investors are going to make less money in their bonds. We're not we're certainly worried about the yield curve inversion, but it seems to me more likely that the yield curve inverting is a signal that the Fed is going to tighten in order to keep the inflation from getting away. And clearly the Fed is not going to tighten. In fact, the Fed may ease again. And the Fed is not the problem here, by the way. If the Fed, as the president says, if the Fed was a problem, that would indicate that interest rates are the reason why the economy is slowing down. And that's not the reason the economy is slowing down. It's slowing down because of the world economy, which is slowing down and likely because of the tariffs.
Interesting. So how are you advising your clients to position their portfolios during this time?
Well, we think that what's going to happen here with the interest rates going down as much as they have, again, 10-year Treasury 1.6% this morning, that investors are going to start to look for alternatives, and we think that the dividend-paying stocks are a great alternative. If you take the stocks in the S&P 500 out that don't pay a dividend, so the remaining, it's about 2/3 of the stocks that are remaining, the remaining stocks pay 3.1% in a dividend yield. So that's double what you can get in a 10-year Treasury. And yes, there's risk, but you have another upside to your dividends, and that is that the dividends tend to go up over time. Unlike when you buy a bond, you lock in whatever income you're going to get.
All right, well, speaking of dividend stocks, let's get to this week's stocks to watch, starting with Cisco. Now, the stock did gap down after its earnings report last week. Investors really honing in on that guidance, but what do you make of where the stock is now and where it could be headed from more of a long-term perspective?
Yeah, so we're always focused on a long-term perspective. Last week was real rough on the stock. They actually beat the expectations for earnings. They beat the expectations for revenues. The market is super focused right now on revenue growth, and the company reported year-over-year revenue growth of 6%, which is much better than average. And so you would think, hey, what would make the stock go down as much as it did last week, and it was comments by the CEO, Robbins, as to the future, and we're not as concerned about that as Wall Street is, because if you look at Cisco's history, formerly run by the CEO John Chambers, for many years, he was famous for talking down expectations, lowering the bar so that then they could exceed those expectations. So when we think that perhaps Robbins is doing the same thing here, when he made his forecast for the rest of the year in terms of sales growth and earnings growth, he put 0 in for sales to Huawei. And already this weekend, President Trump said they're going to give a 90-day extension to companies doing business with Huawei. So this morning Cisco is outperforming. It's up 1.5% compared to the market's 1%. So already we're seeing the fact that Robbins was probably a little too pessimistic in his comments about the future.
Right, maybe a bit of a conservative guide there.
Right.
And then in terms of the stock, it is well off highs. For those growth investors looking for a little bit of momentum, it would be nice to see it firm up here, maybe get above its moving averages. But in terms of your outlook for the stock and the dividend that it provides, potentially a good name for a longer term position?
Well, we just love high dividend stocks, and we love them even more if they increase their dividends. So Cisco in the last 4 years, just 4 years, they've increased their dividend by 67%. That's pretty darn good. So dividend increases come from free cash flow. So their free cash flow yield is above 6% right now, so it's more than double the dividend yield of 3.1%. So there's plenty of room for them to keep increasing their dividend, and we found that the surest way for a stock to go up would be for dividend increases over time.
Interesting, so a good dividend play here, and profitability being a key metric that you're looking at when you're analyzing potential positions?
Well, our favorite metric is free cash flow. We look at that from a number of different ways. One of the ways to measure free cash flow would be cash that's available to be returned to shareholders, either through stock buybacks or dividends and dividend increases. And like I said, they've got a lot of it at over 6%. And right now in the tech sector, in fact, it's hard to find tech stocks that are reasonably priced and that are very profitable right now, as opposed to some projections into the future.
All right, well, let's contrast that then with Netflix, which if you look at the chart here, it's pretty much gone nowhere really for the whole year, but taking a step back even further, has had a huge run, but it looks like the fundamental picture is now changing a little bit. They are still spending a lot of money on their original content, and competition is steepening.
Well, look, it's a great story, and we have never invested in Netflix, so you don't pay a dividend. It's not our type of stock. But the story is certainly, they went to, I think it was around 2002, they went to Blockbuster and they said, "Why don't you take us over?" And Blockbuster said no.
Right,
boy,
now we know what happened from there.
Yeah, and so yes, from there until earlier this year, where the stock made its high, you would have been 200 times your money from I think 2002, sometime in the middle of 2002, 200 times your money. But that's part of the problem. The stock has just gone up too much. And if you look at the metrics on the company, they're going to have a negative free cash flow. We talked about a second ago with Cisco free cash flow yield. They're going to have minus $3 billion of free cash flow this year. They're spending $3 billion more than they're making, bringing in. That's not the same thing as earnings, but in terms of the money that's available for things like dividends, they don't pay a dividend because they don't make any free cash flow. So, and if they're not making money now, where are they going to be once Disney comes out with their streaming service in the fall at I think it's at $7, and which is much cheaper than their service. And then after Disney comes out, you're going to have Comcast coming out. You're going to have AT&T with their Time Warner unit coming out. You've got Hulu. You've got all of this competition coming out with streaming services. And they took away Friends, and they took away the Office,
valuable
content, which they're still streaming now, but they're going to come off of Netflix anyway. So if they're not making money now, when they've got streaming more or less all to themselves and easy to get content, I don't see how they're ever going to make any money.
Yeah, well, I guess that begs the question of, will they change their business model with all of this competition, maybe look at live content or sports to, I guess only time will tell what they're going to do to really tackle this competition head on.
Well, I think the reason the stock went up so much is because of what happened with Amazon. Amazon did something that nobody's ever done before, and they said, we're going to build scale to a level that nobody's ever seen before. We're not even going to worry about making money, and that worked out fine for Amazon because they got such tremendous scale, and of course retail, and now Amazon's making money, and it worked for them. Okay, and Amazon's certainly not going to go out of business. Amazon in great shape. But they're not. It's not the same story as Amazon.
Right.
The scale. There's only so far you can take scale in that business, and you've still got to create the content, which is very expensive. That's where they're spending their money. So I don't see how the Amazon lead has anything to do with Netflix. I just don't think that if they haven't made it already, they're not going to make it.
Interesting. Well, we're going to have to leave it there for now, but thank you so much for all of your insights today.
Thank you, Alissa.
Really appreciate it. All right, and coming up next, we're going to continue the conversation about large cap tech stocks. I'll be breaking down key tips to help you filter out the noise and find the best buys at the right time after the break.
Leaderboard helps you invest better with winning stocks picked by our team of experts. Select a stock to see current analysis. Check the chart for buy and sell points, plus get real-time price alerts. Improve your investing with Leaderboard. Start your free trial today.
When you're buying stocks, it can be tempting to have a bias towards popular stocks or those with top-tier name recognition like Netflix or like Cisco. But the name alone won't guarantee big gains in your portfolio. That's why it's important to filter out the noise and combat your bias by leveraging data and charts to help you make your buying decisions. So today, let's go over IBD's tips for buying large cap stocks. Now, of course, this is a great guide to use when you're considering any stock to buy, but it's especially important to keep in mind when you're looking at these bigger popular stocks to make sure your emotions don't get in the way. So first, don't buy stocks simply because they're widely held. Take GE, for example. That's one of the most actively traded stocks in the market, even though shares have essentially been in a free fall for the past 2.5 years and growth has slowed tremendously. Now, the company is trying to turn things around, but it hasn't been able to do so yet. So instead of buying a big name stock that looks cheap, analyze the chart and fundamentals first. Fundamentals are key because stocks follow their corporate earnings. Remember, it's ideal to see bottom line growth of at least 25%, and it's even better when that growth shows acceleration. And the chart is important because our research shows that buying stocks that are already in uptrends increases the likelihood of profiting from that trade. Now keep in mind, of course, that timing when you sell is just as important as timing when you buy. Now, making sure the chart and the fundamentals are up to snuff also prevents you from getting carried away with the story of a stock. This is where Tesla is a great example. Tesla is no doubt an innovative company with a great story, but the stock is now trading at the same levels it was all the way back in 2014. So if you held that stock for 5 years, it's essentially gone nowhere as the company continues its cash burn. Okay. So now, let's put Apple and Microsoft head-to-head to demonstrate another concept here. Don't expect leading stocks will always be leaders, and don't expect lagging stocks will always be laggards. So to explain this, let's first take a look at a weekly chart of Apple. Now, Apple is a long-time holding in many portfolios, of course, but for position traders, the stock is flashing some weakness. Apple staged a breakout over a cup with handle base several weeks ago, but shares hit resistance at the buy point and quickly turned tail amid broader market weakness. The next week, Apple triggered a sell signal by falling more than 7% below the proper buy point. That means this buy point is no longer valid, even though the stock is trying to rebound. Now, the week chart action comes amid fundamental weakness too. Apple has now seen 2 quarters in a row of declining earnings, and sales growth is also weak amid waning iPhone demand. So in short, just because Apple has been a big winner in the past, investors shouldn't automatically expect it to be a leader now and moving forward. Now, Microsoft's chart, on the other hand, shows somewhat of the opposite picture. After peaking in the dot-com era, it took Microsoft nearly 16 years before it reached new high ground again. So Microsoft was a long-term laggard until about 3 years ago. Earnings and sales growth has consistently been in the double digits over the past year, and the chart looks strong. You can see how compared to Apple, shares of Microsoft were able to hold up much better in the Q4 2018 correction. Microsoft broke out of a cup with handle base in late February, and after a 22% run, shares formed and broke out of another base. And Microsoft is currently trading within the 5% buy zone as it seeks support at its 10-week line. So all in all, don't let a personal bias or preconceived notion get in the way of finding the best stocks at the right time. And instead of buying an individual big cap stock that's a laggard, your portfolio would be better off buying an ETF that contains an array of large cap stocks as its holdings. We'll talk about what exactly the QQQ ETF offers investors when we come back.
This season on Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3 AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
If you want your portfolio to have exposure to large cap stocks, another way you can do so is with an ETF. Invesco's QQQ tracks the NASDAQ 100 and boasts tech heavyweights Microsoft, Apple, and Amazon as some of its top holdings. And here now to share insights about the ETF is Ryan McCormack. He's the QQQ strategist at Invesco. Thanks for being here today, Ryan.
Thanks very much for having me.
All right, so we'll get into the nitty-gritty of the makeup of the ETF, but first, taking a step back, can you comment on the level of outperformance that we've seen with this ETF when you're comparing it to the broader market over the long term?
Yeah, absolutely. I mean, I think as you look at QQQ and the performance that we've seen, particularly since inception, we have 20 years of live performance, which is something that not a lot of ETFs can boast. And particularly in this most recent market cycle, post kind of 08, we've seen significant outperformance relative to both the S&P 500 and other growth indices.
All right, and since it tracks the NASDAQ 100, of course, you have those big tech heavyweights in there that I mentioned earlier, but can you talk a little bit about the full makeup of the ETF in terms of, yes, we are getting a lot of exposure to tech, but also exposure to some other sectors as well?
Yeah, no, that's a great point. And I feel like when you look at QQQ generally, that's a misconception that we get a lot. In years past, it has been significant weightings to technology, but as you look at it today, our technology weighting is under 50%. We have significant exposure to consumer discretionary names, to communication services names. And I think when you look at tech as a whole, the paradigm has kind of changed. It's very hard to put companies in just one specific tech box. Right? As you drill down into the autos, right? You have self-driving cars. Right? You only think of auto companies as technology, but there's certainly an aspect to tech in their underlying business. So, we believe that the makeup of NASDAQ 100 and specifically QQQ is kind of large growth across the board.
Interesting. Yeah, I think that's an interesting point that every company, whether it is in retail or communications, what have you, having that tech edge is really important to keeping sustained growth. And something else that's important is strong research and development, and that's also a common thread with the names in this fund.
It is, absolutely. I mean, we believe that QQQ is a very innovative fund, right? And I think in an effort to stay innovative, right, you need to be reinvesting in your business. As you look at the NASDAQ 100, R&D reinvestment rates are near 10%. So meaning almost 10% of sales are reinvested in R&D in these underlying companies. So what you get from that is, not always a one-to-one kind of parallel of, oh, this dollar went to here, but as you look, these are the disruptors, the innovators that are out there in the market, and consistently they're the ones that are bringing innovative products and frankly, innovative ways to make money out to the market.
Yeah, and then that in turn also boosts the fundamental picture as well, bringing new products to market, boosting sales, strong earnings, and that's something that our audience is really focused on, is the strong fundamental picture of these names. And with that R&D spend and reinvestment, do you see that really translating to the fundamental picture as well?
You do, and to go back to your earlier point about technology, right? I think as you look at tech of the past, right, you really just needed a website to be considered a technology company. right? Really no earnings, very limited sales. It's a very different picture, not really your parents' technology companies. I mean, as we look, Google celebrated its 15th year IPO today. Right, so pretty big anniversary. It's hard to believe that Google, not being kind of a traditional tech company that's been around. But as you look at this, this reinvestment in R&D, it really has changed these businesses for the better, right? They're delivering results to the bottom line. And as you look at the companies in QQQ on average relative to, say, the S&P 500 or, again, other growth indices, what we've seen is significant sales growth, significant earnings growth, if you can believe it, even significant dividend growth. So even maybe non-growthy type aspects of the market, we're seeing that shine through in QQQ, specifically relative to other indices out there.
Specifically on the dividend point, what exactly are we seeing in terms of that being an appeal here?
Yeah, so I don't think you're going to buy QQQ for the dividend yield, right, anytime soon.
Maybe an added bonus?
It is a nice little icing on the cake, perhaps, but I think when you break it down, you're seeing these companies are finding other ways to deploy their cash. Again, looking back at old tech companies from years past, you would shake your head if they announced a dividend. Now it's almost commonplace. Right, so this cash that they're earning, not only are they redeploying it in R&D, but also in other ways to bring value to the shareholder, in this case, dividends.
Right, so it seems like, the tech weighting is there, but it is diversified. So how do you see this ETF fitting in investors' portfolios?
Yeah, I think it's firmly in the large growth category. I'm a big believer of knowing what you own, and it's going to be a concentrated large growth type ETF. Right, 100 names, you'll have some concentration at the top, but you really are getting access to the most innovative and growthy companies that are out there.
All right, well, it was a fantastic conversation. Thank you so much for shedding light about this ETF for our audience. We're definitely focused on the growth space, so this matches that, I guess you could say. Thanks so much for coming in today.
Thanks for having me.
All right, and thank you all for watching Investing Strategies. I'm Alissa Coram, and we'll see you next week for our show on emerging trends.